All right, another update on the stock market while we wait for the trade in the metals sector that I'm anticipating is to come. I think it's going to be, as I've said, I think that could be the trade of the year, but it's still setting up. We're not ready yet for a big trade in the metals. In the stock market, we have this is the futures, but you can see the first. Well, first off, we've got a V-shaped rally, which of course the perma bears or the analysts trying to pick a top were not expecting this at all. They were expecting an immediate retest of these lows, and with central banks printing just trillions of dollars, that was unlikely to happen. So we've got this V-shaped recovery. Price had gotten stretched way too far below. This is the 50-day moving average, but the 200-day moving average is also way up here. So price had just gotten stretched way too far below the moving average, which was a recipe for this V-shaped recovery, along with central banks printing a lot of liquidity. So we had our first test of the 50-day moving average here. I've noted this before. Sometimes when the average is falling really aggressively like this, the first attempt to recover usually doesn't succeed. The momentum is just too strong, moving lower. So you'll get an initial test. Sometimes, as in here, it'll close above it briefly, but then drops back below, and it'll have to make another run at it, which it has done this past week, and again starting this week. So we've recovered here again, and let me switch over to the actual S&P. All right, so you can see first attempt failed. We'll get a pullback into this is the half cycle low. We should have a few more days, anywhere from 5 to 10 more days for this rally to continue before we get a deeper pullback. This half cycle low was very mild, only lasted two days. The pullback into the daily cycle low usually lasts anywhere from 5 to 8 days. So typical duration for a daily cycle low would be somewhere between day 35 and day 45. So I'm not really expecting a top until past day 30. Today's going to be day 25. So as I said, we should have at least, I would think, at least 5 more days for this rally to continue before topping. My guess is that we're probably going to tag the 200-day moving average up here, or get really close to it before starting to move down into the daily cycle low. So I've kind of put some guesses on here. If we assume that we're probably going to tag this 200-day moving average, or at least get close to it before we have a larger daily cycle correction, then the Fibonacci retracements from a rally of the bottom here in March to a tag of the 200-day moving average, a minimum, usually a daily cycle low will retrace at least a minimum of 38%, or back to the 38% Fibonacci retracement. That would be down here pretty close to 2,700. That would rebuild the wall of worry, where traders are going to be starting to get pretty bullish. Although intermediate, I'll show you here in a minute, intermediate degree sentiment is still significantly depressed. Not we haven't it's not bullish enough yet to power a retest of these lows. We haven't built enough fuel for that. But a daily cycle low somewhere down here around 2,700, I would think, and then I think we get a second rally, the second daily cycle, which may left translate, but I think that second daily cycle will break through the 200-day moving average, just like this second rally attempt here did break through the 50-day moving average. And then we'll get a top to this intermediate cycle somewhere. My guess would be between 3,100 and 3,200. I don't really think the S&P is going to retest these highs. There's a chance, I guess, that it could fill this gap here before we top and then start moving back down. But my feeling is we're probably going to be stuck between 3,150 and 3,200, and probably somewhere down here between 24 and 26 during the next intermediate degree correction. I know a lot of analysts think we're going to come back down and test this low, and many of the perma bears are expecting uh, that we're in a long-term bear market like we were from 2000 to 2009, and I just don't think that's the case. I think we're still in a secular bull market, but we are stuck in a cyclical bear market. So I tend to think this is the 4-year cycle low. I don't think it's going to get broken, but we will test it to some degree. Like I said, I'm kind of anticipating in a range between 3,200 and 2,400 here. So the next intermediate cycle low, with central banks just printing trillions and trillions of dollars, I doubt that the market is going to be able to fully test or break this March low. But we could get down here to somewhere between 2,400 and 2,600. So this is sentiment, intermediate degree sentiment. You can see right here, we're just barely starting to emerge from excessive bearish levels. Um, in order to start the next intermediate leg down, we've got to build some more bullish sentiment. Um, you can see during the bear market here, these bear market rallies still managed to push sentiment uh, back up here to fairly bullish levels before rolling over. The only um, one that didn't um, was right here, and it still managed to get back to about 50% bulls, which is kind of the norm during a long-term bear market. This was a secular bear market. Um, so in a secular longer term bear market, which I don't think we are in, um, you would expect to see at least a minimum uh, retracement of about back to about 50%, 50 to 60% bulls before the market rolls over again. And you can see we're not even close to that yet. So we don't have the fuel to power another leg down. We need to get more people bullish in order to for this market to top and roll over, and that would be if we are in a long-term bear market, something that's destined to last like a year and a half, 2 years, and I don't think we are. I think this was a very quick cyclical bear market that has little chance of rolling over and making a lower low, not with central banks printing trillions and trillions in liquidity. So, but I do think we are going to roll over at some point here. Probably are not going to make a higher high, not during this intermediate cycle, um, and we're going to test that 24 to 2,600 range again in the S&P. But before we can do that, we've got to get some more people bullish. So I think um, we've got to probably test the 200-day moving average, and we probably got to get back above it. As I showed in my last chart. I'll put that chart back up. So I think, like I said, I think we're going to maybe a retest of 2,700 here after we tag the 200-day moving average, and then I think we've got to break above it. Get somewhere in this 31 to 3,200 level, maybe long shot, maybe we can fill this gap. But then at that point, I think we would be set up for another decline into assuming normal timing band duration, we would get our next intermediate cycle low sometime in probably in early to mid-July. But for now, I'm still seeing a lot of analysts on YouTube videos of analysts, trying to call a top day after day. And as I've just shown you, sentiment is just not bullish enough yet for a top. And um, we've still got some days left before this daily cycle even tops, and we get a deeper correction, at which point the perma bears are going to lose their mind, calling, for another move down and a continuation of the crash, and they are going to be wrong, just like they were wrong about this V-shaped rally. We'll have another leg up, and it will probably break above the 200-day moving average. And then when all of the perma bears finally throw in the towel um, and get long, then that's when we'll get our intermediate top here, and then we'll come back down and get our next intermediate cycle low probably sometime in July.